in this example, we're going to look at, again, being the seller in the situation and what happens when a customer actually returns something to us. So it tells us that Showcase Companies, the furniture wholesaler, sells merchandise to Balboa Company on account. They have the terms of net 30. Cost of goods sold is $142,830. And Showcase is going to issue a credit memo to them for $30,309 for merchandise that was returned prior to Balboa actually paying that original invoice, and the cost of the merchandise return is at $18,280. And they tell us for the purpose of this, since they aren't given any actual dates, just to use December 31st for all of them. So we're making a sale. So we have accounts receivable, and we're going to make it specific since we know who owes us money. So it's accounts receivable from Balboa Company for the $273,840. That is the sales price, so it goes into our sales revenue account. We know every time we make a sale, we have to have 2 journal entries. So the second one is our cost of goods sold. So our cost of goods sold here is $142,830, and the goods that I'm selling is my inventory. So I now have less of my inventory. They then are going to return something to us. So remember, when they actually return the goods to us, we need 2 journal entries. If they don't return the goods to us, they actually just keep the inventory and maybe get a discount off of what they owe. We only need 1 entry, but because here they are actually returning the goods to us, we need 2. And the first is we have to do is looking at what we're doing for our customer. So we're going to debit our customer refunds payable for the $30,390 that we are going to credit to Balboa. So if you notice, Balboa hasn't actually paid us any cash yet. They purchased that inventory on account. They haven't made any payment to us yet. So we are certainly not going to give them a cash refund. We're going to give them a credit memo. So we're going to debit our accounts receivable to Balboa Company for that $30,390. They're going to be receiving less money in the future from Balboa because they've made a return. And what they returned to us is inventory. So we're getting some of our inventory back, so we have to increase that asset account. And we're going to reduce our estimated returns inventory. It's no longer an estimate. We're actually getting that inventory back. So we have to record a decrease to that estimate that we had calculated at the end of the year. And then finally, we're going to get a payment from Balboa. So we're going to record what we're receiving. So we're getting cash from them. So this is really important, and it's helpful when the company name is included when you're doing this for several different companies, because it's easy to see where those accounts receivable are impacted. So we see that accounts receivable increased here by $273,840, but then we've reduced it by that returned amount of $30,390. So we subtract the 2. One's a debit, one's a credit. We know opposites subtract. They owe us $243,450, and we can get rid of their outstanding accounts receivable of that $243,450.